Hello. Today we'll look at inventory management. So we're still looking at working capital management. Remember I said working capital here. We'll look at account receivable, we'll look at inventory, and we'll look at cash. Those are the three major components of working capital that we'll spend time on. There's also account payable, but account payable is very straightforward. What you want to do is to maximize this as much as possible, and that can be done by just negotiating with your supplier. So we're not spending time on managing account payable. Account receivable, we've covered that in my previous videos. Now today we want to look at inventory, and in subsequent videos I'll also look at cash management. So let's focus on inventory management. Remember the objective, well, of managing inventory is to do what? So why do we have to manage inventory? Why? What are the objectives? Our objective is to minimize the cost associated with managing inventory. That is our objective. We want to minimize the cost associated with inventory. And the next question is, what are these costs? What are these costs? The most popular one is the cost of the inventory, which is the purchase cost. The next one is the storage cost, which is called the holding cost. Usually this is your storage cost. So things like you have to pay the warehouse, you have to pay rent, some inventory gets damaged, so that goes into your wastage cost and all of that. So storing the inventory is not cheap, it's going to cost you some money. And there's other one called the ordering cost. The ordering cost is like admin cost. All those efforts that you have to put in to ensure that you're able to place an order, right from when the need for that inventory has been identified to when the order is being placed. So maybe you need to buy even paper to issue a purchase order, or you need to put some things together, pay the staff in account, pay in the procurement department and all that. So that cost is attributable to ordering cost. And the last one is the stock out cost. So stock out cost is the cost of not having inventory when customers are placing orders. So, and this can be attributable to loss of revenue because you are not able to sell. You don't have inventory to sell. And even beyond that, you might lose customers. So loss of customers because customers don't like their orders being rejected. You force them to go and look for alternatives, and when they find alternative, they might never come back to you. And if you keep losing your customers, you might actually be out of business. So is that really, really bad? So stock out cost is a very dangerous part of it, and you want to minimize it as much as possible. Ordering cost, you want to minimize it as much as possible because every time you place an order, you incur ordering cost because you have to prepare for placing that order. Then holding cost is the cost of keeping those inventory in your warehouse, and you want to also minimize that as much as possible. You don't want to keep too much, and at the same time you don't want to keep too little that you are running out of stock when customers are placing orders. And likewise, purchase cost is about the price you're paying. Remember, purchase cost is price times quantity. So you want to minimize the price of your inventory that you are buying as much as possible. How can you do that? There are various ways you can do it, and all of that we'll look into. How do we now minimize this? Because remember, our objective is to minimize the cost associated with inventory. So that is why we are trying to manage the inventory, and we're not leaving it to chance. We want to be deliberate. So the next question is how? How do we manage it? There are three major methods that you can use to manage your inventory. The first one is bulk purchase discount. So you can take purchase. I'll explain each of these individually. The first one is bulk purchase discount. The second approach is to use economic order quantity. That's another model you can use. And thirdly, you can also adopt a just-in-time approach, JIT, very popular as well. Right. So these are three methods that you can use to minimize your inventory cost. All of these four items. Yeah, adopting any of these three methods will reduce your total inventory cost. So all these four types of cost makes up your total inventory cost management. Yeah, total inventory cost. But let me quickly mention this. So in this paper, we're only going to focus on the first three. The stockout cost for calculation is not relevant, but it's good to know it because you can also use it to explain or additional, you can use that to bring in additional perspective to your discussion, especially if you have a question that is coming in section C, asking what are the implications of adopting some of these inventory management techniques, because some of the risk might be stock out and you will look, we'll see it when we go into each of those methods of managing the inventory. So calculation wise, stock out is out of it, but in terms of qualitative consideration, yes, it is going to be relevant. So take note of that. So for the calculation, we'll focus on purchase cost, holding cost, and ordering cost. Yeah. And how this can be tested is usually you have a question, and the question will ask you whether a company should adopt bulk purchase discount method or economic order, or might even ask you maybe the company should stay as it is, which means status quo. Yeah, the just-in-time approach, most times as well, you won't need to do a calculation on this. So what you need to focus on calculation is one and two, but you need to understand what just-in-time is all about. Yeah. And how do you decide in that question whether a company should hold on as it is, status quo, which means continue the business as usual, or they should use bulk purchase discount, or they should use EOQ? Usually, that is how you'll be tested. All you need to do is to just use this approach, which means, and I will explain each of the method, yeah, but just want to give a perspective how you can be asked. You list out those three costs that I've mentioned. In fact, how many costs? Yeah, three of them that are relevant: the purchase cost, the holding cost, and the ordering cost. So you have your purchase cost, you have your ordering cost, and you have your holding cost. Status quo, you put what is the current purchase cost, what is the current ordering cost, what is the current holding cost. Yeah, make sure you do it annual. So annual cost, yeah, annually. Yeah, so under bulk purchase discount as well, you calculate what is the annual purchase cost, what is the annual ordering cost, and what is the annual holding cost. You do the same thing for under EOQ, and you get the total cost attributable to the inventory. Once you do that, the least cost is your most favorable approach, and that would be your recommendation. That would be the basis on which you advise management on which method to use. Now let's talk about these three methods quickly. How do we manage inventory? Let's look at the first one, the bulk purchase discount. So I'm going to solve question on all of this in another video, but I need to explain. This video is just to give you a very quick and crisp explanation on what it is. Yeah, before we go into the question. So bulk purchase discount. How does it work? So usually you have a vendor, yeah, who is selling to a customer. Yeah, selling to a customer. And how does it work? He's telling the customer that, Mr. C, if you buy 2 units of my product, I will sell to you at $10 per unit. Or if you can buy 1,000 units at a time, per order. 1,000 units per order, I will sell to you at $8 per unit. So invariably, he's saying that if you buy small quantity, it's going to be expensive at $10. But if you can buy in bulk, so if you buy 1,000 units in one order, I will sell at 8 units, which means invariably this guy is giving you 20% discount by buying bulk. So this is a discount, about 20% discount being given. So, but it's interesting. It looks attractive, right? But remember, out of the three costs that we have mentioned, purchase cost, holding cost, and ordering cost, by taking this discount, definitely your purchase cost will come down because the price has come down. But what happens to holding cost? Holding cost will go up because you have more inventory to keep. And what happens to ordering cost? Ordering cost will come down because you're going to be placing less orders. Because think about it, if annually you only need 12,000 units and currently you place 1,000 per order, so it means that number of orders in a year will be 12,000 divided by 1,000. So you go to market 12 times. So that's your number of orders. But if you decide to take a bulk discount that allows you to buy, say, 30,000, is another example. So 30,000 per order. It means that you will only place how many orders? 12,000 over, sorry, 3,000 I mean here. Over 3,000. And you only go to the market 4 times. So which means your number of order will be less. And order cost will not change per unit, per order. So which means your annual ordering cost will reduce, will come down. But what happens to holding? Before you used to order 1,000, yeah, per order. You sell that before you order another one. But now you are going to be ordering 3,000. So which means if you order in January 3,000, you don't place order until say April because you sell say 1,000 per month. So you're going to hold 3,000 in January before you would have been holding 1,000. So if you have to hold 3,000 in January, you will need a bigger storage space. And that is why your holding cost will go up when you use when you use the bulk purchase discount. So as your purchase price is coming down, your holding cost is going up and your ordering cost is coming down. And that is why you cannot just decide whether it is good or bad until you do all the calculation. But that is the explanation, and that is how its impact on inventory. Let's look at the second approach, which is the EOQ. EOQ approach is the economic order quantity approach. And what is this talking about? This just believes that there is optimal quantity to order in order to, let me use another word for this so we don't get confused. So optimal quantity to buy, yeah, in order to minimize holding and ordering cost. So EOQ is not thinking about purchase cost. It's ready to leave the purchase cost as it is, but it wants to minimize holding cost and ordering cost. And that is why when you are using EOQ approach, your holding cost, which I'll represent as HC, is always equals to ordering cost. I'll call this OC. In fact, if you calculate EOQ quantity and your annual holding cost, yeah, remember this is annual holding cost. And likewise, annual ordering cost. And your annual holding cost is not equal to your annual ordering cost. If both are not equal, then there is a mistake in your calculation. Either your quantity is wrong or your holding or your ordering cost is wrong. Because at EOQ, both are meant to be equal. Right? So now, how do you calculate the economic order quantity? There's a popular formula which says you have to calculate the square root of 2 multiplied by the annual demand multiplied by the ordering cost per order, then all of that divided by the holding cost per unit. So remember, D is the annual demand, which is the total quantity you need in a year. Then OC is your ordering cost for every order, so per order. And HC is the holding cost per unit in a year. Yeah, I believe this is making sense. So EOQ believes that by the time you're able to minimize your holding cost and ordering cost, you should be able to have minimized the cost associated with managing your inventory. Yeah, and annual holding cost, I need to, so in case, because you can also be asked to calculate the total annual holding cost or total annual ordering cost. Yeah, your total annual holding cost is equals to the opening inventory. Let me simplify it a bit for you so it's easy to understand. It says average inventory multiplied by HC. Remember, HC is holding cost per unit. So you multiply by the average inventory to get the total annual holding cost. And your average inventory is pretty simple. That is just equals to your opening balance plus closing inventory balance divided by 2. So that gives the average inventory. Once you have that, you multiply by the holding cost per unit and you have the total annual holding cost. Likewise, it's good to know how to calculate the total ordering cost, though this one is pretty straightforward. Total ordering cost in a year. Yeah, as you imagine, it's just your cost per order multiplied by number of orders in a year. Yeah. So if you calculate this A and this B, A must equals to B if you are using EOQ. Please take note. Very important, because a good check while you are also doing your practice and exams. Yeah. So your objective is to minimize, remember, cost associated with inventory. But EOQ is helping you do that by minimizing both ordering and holding cost. And when both are minimized, then you are being able to reduce the total cost associated with managing your inventory. And to know whether it's better than bulk purchase discount, you definitely have to do the calculation as I showed on this table, which we'll do a question in the another video, maybe next video. And when you calculate all of this for the two methods, then you have the total. Then you can tell whether currently the company is even better off, or they should take bulk purchase discount, or they should take EOQ. So those are the two that you will be expected to be able to do calculations on. And the last method of managing inventory is the just in time. Just in time, just as the method says, it means you only buy inventory just when there is an order that requires you to deliver a product. So this says buy inventory only when there is order from customers to fulfill. So if nobody wants to buy anything, then you don't have to buy inventory because you don't want to keep inventory. Yeah, so you buy inventory only when there is order from customers to fulfill. So this if you're using this approach, you don't keep inventory. So you don't have to rent a warehouse. You don't need to buy a property to keep it. You won't worry about wastages. You won't worry about damages. You don't worry so much on things going up obsolescent because you don't even keep. Yeah, and if you look at the component of inventory cost, purchase cost, holding cost, and ordering cost, you will discover that this will really take your holding cost to close to zero because you are not going to be keeping any inventory. But guess what? You're going to be ordering as many times as customers are asking. So you probably expect your ordering cost to go up. But the impact on purchase cost might also be tricky. It might not leave it as it is because when vendors realize that you're actually desperate to fulfill an order because there's a customer waiting, they might take advantage of your desperation, and because of that, you might expect the purchase price to go up, and eventually, your purchase cost might go up as well. So, those are the possibilities of how all these methods might impact on the different cost, yeah, of inventory. And the last one, even though you might not be able to calculate it, but you must note it, is the biggest risk with using JIT, yeah, method, and that is the stockout cost. When you use the JIT method, stockout risk is very high. Yeah, but if you're using bulk purchase discount, stockout risk is very low, and EOQ is just optimal, right? So all of this needs to be put into consideration and put into quantitative values to really decide on how a company should go about managing its inventory. We'll continue with how to manage cash in subsequent videos and we'll solve questions as well. Bye for now.